Hello again, everybody, and thank you so much for joining us today for the KPMG nsKnox webinar. My name is Eric, and I handle BizDev here at nsKnox, and I'll be your moderator here today. We are going to discuss today top strategies for preventing fraud in 2020 and onwards, with a focus on social engineering, the challenges that corporations face, and the solution that we offer today. First of all, please allow me to introduce our speakers today. From KPMG, we have Israel Aloni, who currently serves as the Director of Cybersecurity at KPMG and the Global Lead for Secure Payments Joint Solution together with nsKnox. Israel has over 20 years of experience in the technology industry. Prior to joining KPMG, he led product portfolios and product management teams for over 15 years in cybersecurity and fraud detection and prevention companies. At KPMG today, he's leading a cyber consulting practice and technology-powered solutions. From nsKnox, we have today Ilan Allen Schreiber, who serves as the CTO at nsKnox. Alan is recognized as a recognized expert in today's B2B payment systems and knows a lot about the payment procedures used by small, medium, and large organizations. Alan also brings a deep technical knowledge in cybersecurity from his days as a cybersecurity expert in an elite technology unit of the Israeli Defense Forces. One last piece of information about today's webinar. We aim to keep it short and sweet so we can allow enough time for Q&A. So I would like to ask everybody to hold on to your questions until the right time. So Israel, why don't you take it from here?
Thank you, Alan. So, as discussed, we are here today to focus about corporate payments fraud, essentially fraud that occurs when you pay your suppliers, or at least that's what you think you do. However, because of a fraud scheme, the money is routed to a different bank account. Looking at where we are today, there are many forms of that type of fraud, starting from essentially psychological tricks, vendor impersonations, well-crafted social engineering emails, commonly known as business email compromise, where someone pretending to be your supplier would send a very convincing email asking you to change their bank account. We've also seen quite a bit of email account compromise, where the fraudster is actually preparing and collecting intelligence by taking over either your email account or the supplier bank account, email account, sorry, in order to learn how the two sides interact with each other. This continues to other very different forms, such as insider fraud, people within IT, finance, procurement, etc., who know very well the internal processes, the internal controls, and therefore are in a very dangerous position, not only to circumvent and bypass the controls, but also to go back afterwards and cover their traces. And it goes all the way to hardcore cyber attacks, for example, targeted specialized malware going after common and leading products in the market, in the ERP market, whether SAP, Oracle, and the likes, especially targeting those systems to go and tamper the data in those. So these are the forms of it, and the next obvious question, can we go and understand where we are, not just in qualitative terms, but in quantitative terms? And the answer is, this is a very substantial problem today. First and very obvious, we're talking about business payments. And yes, there are always the small random payments to very niche suppliers, but most of your business payments to your repeat major suppliers would typically start at thousands and tens of thousands of dollars, but could easily reach hundreds of thousands or even millions in one transaction for a very substantial supplier of yours. Those numbers, those sizes and volumes of transactions mean two things. One, they make a very interesting target for fraudsters. And second, if such transaction is compromised and the money is routed to a fraudster account, then this could mean a very significant hit to your company. In fact, recent research shows that when companies get hit with that type of fraud, on average, that translates to 0.5% of their annual revenues. Now, you could think initially that 0.5% is a small number, but consider a $500 million company in annual revenues, or 1 billion in annual revenues, and I'm pretty sure some of the audience today represent such companies. That percent of fraud would actually translate to $2.5 to $5 million lost in 1 year for one or few transactions. That's a lot of money. That's a lot of bad PR if you're a public company. That's a lot of money wasted after your teams worked very hard to sell and deliver those products to your clients. And if that's the top line number, then the actual hit to your bottom line profitability is even more significant. Now, that's at the individual transaction, individual company, which begs for the next obvious question. So how likely are we, an individual organization, to get hit with this? Is the risk really that high? And what the numbers are showing us that yes, they are. On the right, we can see that the percentage of companies that get hit with those attempts go up year over year. And also we know from a recent study by the SEC and the FBI that actually get refreshed every year now, is that that problem is estimated globally at $26 billion only in the last 3 years. And in fact, the year before, those figures were smaller, which tells us that this is not a problem of yesterday. This is not a thing of the past. It is not a stagnant problem. In fact, that problem is only increasing. And this is the reality where we are today. Our objective overall is to help your company to not become part of that statistics and find yourself losing that amount of money. And to understand how that happens and what are the exact controls that fail today and what we could do better, we thought it might be useful to start with a few examples. Some of those were highly publicized. You may have read about them already. The first one I'd like to discuss was just publicized maybe a couple of months ago. Nikkei, the Japanese conglomerate and financial services firm, lost $29 million in fraud, actually through one of their US subsidiaries. And what happened in that particular case was a mid-level manager in the finance department of that subsidiary who received an email allegedly from an executive within the subsidiary, instructing him to make a money transfer, a very substantial one, as we see. To further convince that finance manager that things were okay and that was a legitimate request, that supposedly executive also left a voicemail. And of course, when the finance manager not only read the email, but also checked his voicemail and saw which phone number within the company the call came, and listened to the voicemail and recognized the voice, that was basically all he needed. It made total sense to him, and he followed the instructions and transferred the money. What he didn't follow was the actual formal process of the company that required a callback for every transaction above a certain threshold. But because the email looked very convincing and because the voicemail sounded very convincing, he followed the orders. Unfortunately, the email was not authentic. It was spoofed. Again, well-crafted social engineering. And also, more worryingly, and this is a good example of how fraudsters are adapting new technology, the voicemail was not left by that executive at all. It was left by a recorded deepfake AI that was trained to look, to sound, and talk like that executive. So two digital evidences convinced that finance manager and he actually made that transaction. The second example happened at Tesla, the car manufacturer. Here, a slightly different story. It was actually a bad insider. So one of their supply chain managers who closely interacted with few major suppliers and had intimate relationship and knowledge about the due payments, the end or the termination date of one contract with one supplier and moving over to another supplier, actually leveraged his inside information, both on the suppliers, on the due payments, and also on the actual processes and controls, and triggered a change request details for the bank accounts of those suppliers. After that change was made, it was followed by fictitious invoices as well as real invoices that just went to the wrong bank account. So what we see here is probably insufficient controls because someone with the inside knowledge about them actually circumvented them quite easily, made a request, made sure the approvals were there, and allowed those money transfers to be made. For the third example, we would keep the company name confidential. That was actually a fraud case that KPMG itself investigated through its cyber and forensics teams. And here, what happened was a supplier that is very major in their market, and they deliver a certain type of equipment to many, many customers internationally. They have a very nice market share in their industry. And the fraudsters realized that and thought that rather than going and attacking just one customer at a time, he could actually reach scale by attacking the supplier first. He started by hacking into one of the supplier's staff email account, and once getting control, sent multiple emails on behalf of that person. So not a spoofed email from outside a company, but an actual email from the actual email account of the supplier to multiple customers, asking them to change the bank account in their systems for that supplier and start paying to that from the next payment cycles. Unfortunately, multiple customers didn't check anything at all. They just trusted the email. And within less than 10 days, over $3 million through multiple transactions were moved to the fraudster's bank account instead of the supplier's one. It was only after 10 days that one of the customers finally suspected something. He only then got that email or opened it, and they reached out to the supplier. And shortly after, it became clear that that was a fraud case that hit multiple customers, multiple transactions. I find this particular example interesting because it tells you that it's very risky to rely on someone else in that chain to do your work. If customers relied on their supplier to have a good IT security hygiene, that proved to be a wrong assumption. And the other way around, if the supplier hoped that his customers would be more aware, they were not. So if we think about those three examples, although the stories are a bit different, the companies are different, but there are multiple repeat patterns in those three cases. And unfortunately, in many others that we either hear about, read about, or help go and investigate. First, in most cases, when companies onboard their suppliers or make changes to the details, they tend to rely on digitally provided evidences, whether it's pictures, scanned PDF documents, emails, phone calls. Problem is, those evidences, including phone calls, as we saw in the Nikkei story, could be easily forged. Secondly, is the dependency on a single source of information, whoever is the interested party making the claim. If that party is the fraudster, then we have a problem. Thirdly, and very commonly, companies rely primarily or only on manual controls operated by humans. And that means reliance on human judgment, which could be tricked or processes could not be followed. At the same time, those controls are internal, and therefore, if internal employees do not follow the process, or if internal systems are compromised, then basically the fraudsters have the keys to the kingdom with nothing else to stop them. And lastly, if we think not about the attacker view, but the defender's view here, we need to acknowledge that there is an exploitation ongoing here of complex processes that are siloed between departments, siloed between the controls that different people are responsible for. It's very common that when we meet customers to learn that the procurement team knows part of the process and is responsible for some of the controls. The finance account payable team would have different partial visibility. The IT security team would only focus on certain things without awareness to the others. And fraudsters love those complex siloed processes. They found their way in exactly thanks to that. So we went through multiple examples and then looked at the common patterns in those. And if we think about how we could start thinking about doing things differently, we first need to acknowledge those fundamental challenges and things that we should consider. One, how well do you really protect those business processes that you have? Namely, how well do you validate your supplier's bank account when you onboard or change them? And secondly, how well do you protect your payment run, your payment processes and infrastructure from data manipulation and data tampering by fraudsters? The reality today, again, that we mostly rely on humans to operate manual controls. But the problem is not only the stories we reviewed, but also a well-known statistics in compliance training that 20 to 30% of the people don't even follow the process in the training, where they know that they're being looked at and expected to be well compliant with the requirements. In reality, under pressure, under psychological tricks, they're even less likely to follow those processes. And to make it worse, even if people do follow the manual controls and processes, sometimes the technology is just in a better position to outsmart them. So this man versus technology equation is not working very well. And to add to that, those payments and procurement and supplier management processes today are complex. The more global and multinational companies become, the more international their supplier base becomes, the problem only gets worse. And many times what we're seeing at customers' environments is that when they have multiple teams, multiple systems, multiple processes, not only it's complex to operate, but it also means that they lack central control and central visibility. So at KPMG, we looked at all of those cases, and of course, many more cases that we reviewed, and the patterns under them. And we really consulted our different teams at KPMG, whether it's IT controls, compliance teams, forensic experts, cyber analysts, and others, and asked ourselves if that's the reality, if those cases not only continue to happen, but even increase in volumes every year. And if the repeat reasons are the ones that we discussed over the last 10 minutes, then what would be top strategies to mitigate that? And we have come up with 4 top strategies to help companies better defend themselves against supplier payment fraud. Number 1, you really want to add automation into the mix to the possible extent. More automation means taking human judgment out of the equation, and I mean that at multiple levels, not relying on humans to trigger validation processes, not relying on human judgment to identify suspicious things, and not to rely on humans to follow the processes and controls that they are expected to do. So the more automation here, the less chances you have for mistakes. The second strategy is we need to think about securing those business processes holistically, because they are holistic processes. Not only to remove complexity and friction, but to provide fraudsters less opportunity to find cracks to sneak in. And that means holistic, integrated, multi-layer defenses that work in tandem. The third strategy is just relying on internal systems, internal databases, and internal controls is risky, because once an attacker is inside, or once you're dealing with a bad insider, they could compromise those, the integrity of those controls. So adding an external and independent data source or control to the mix for cases that even if you're compromised internally, that external control cannot be touched, that could be your last and most important safety net. And the fourth strategy is you want to add efficiency into the mix, not just to streamline and offload your own procurement and finance team so they can be freed up to do something else, but also because adding efficiency through automation and through more advanced techniques will actually help you deliver better and faster service to your organization, whether it's faster and easier onboarding of suppliers at better SLA, or shorter and simpler review cycles for payments. So these are the top strategies, and of course relating to the topic of the webinar today, that we have come up with at KPMG after analyzing those many cases, like the 3 examples I shared with you. And to help take this to the next level and to actually help customers implement those 4 strategies, we have turned to nsKnox and created an alliance with them. And at this point, I would like to turn it over to Alan, our CTO, to walk us through the solution and how those approaches could implement it in reality. Over to you, Alan.
Thank you, Israel, for this clear analysis of where we are today, what is the reason that we are here today, and what we should do next. I'm now going to speak a bit about nsKnox and about our technology, which is the engine that runs the secure payment solution by KPMG. So nsKnox is a cybersecurity company and a fintech company, and our goal is to protect the money of our customers when it comes to corporate payments and to accounts payable. What we do is to ensure that these cases, the cases that Israel described earlier, mainly social engineering, insider fraud, and vendor impersonation, will not happen to our customers. And for that, we built a solution which is composed of 4 major layers or 4 major pillars. The first pillar, we call it a smarter way to validate your supplier bank accounts details. And what it does is to ensure that when you're paying to your supplier, for example, whenever you pay to Coca-Cola, then you will know for sure that the payment really goes to Coca-Cola. And that's because you will know that the account that you're using really belongs to that company and not to any other company. Now, we call it a smarter way to validate your vendor's details because it doesn't rely on any documents that you might be exchanging today with your supplier to validate their identity. It also doesn't rely on any phone calls that you might be having today to do the same. Actually, we don't rely on any information that arrives from your suppliers. Instead, we are using external, independent, and well-validated information that we provide to you. You can consume it as a portal that draws its information from a database, where you ask whether a certain account really belongs to a certain supplier and get an answer whether it is true or false. And this information is taken from 3 major sources of data. And the first source of data is the banking system, or to be more precise, the anti-money laundering system that runs within the banks. This is part of our secret sauce that we learned how to extract this information when it is required. The second source of information is statistical anonymized data that we collect and provide it to our customers so they will be able to perform the right judgment. And the last source of information is managed service provided by KPMG. That's an example of the synergy between the 2 companies because KPMG have teams that their expertise is to validate business information, including bank account details. So all in all together, these 3 sources of information provide good answer whenever you need to onboard a new supplier or whenever you need to change the details of an existing supplier and validate its details. So this is the first pillar, and it does a great job in managing your suppliers. But of course, this is not the whole story because there is also the payment process. The payment process that runs in your company once a month, maybe once a week, or maybe every day. For that, we have the second pillar. The second pillar protects the payment process, and it ensures that no one, but absolutely no one, not even the CIO of the company or the CFO or the most trusted person in the organization, will be able to manipulate the information and interfere with the payment process. It means that no one will be able to change the payment files that you are uploading to your bank. No one will be able to create fictitious vendors like as it happened in Tesla. And no one will be able to change the vendor master data without you knowing about it. Because what the second pillar does is to ensure that every payment that goes through the door of your organization goes to a beneficiary account that was first validated by the first pillar. And together, these 2 pillars, the first and the second, provide a holistic end-to-end solution to the payment process, starting from onboarding a vendor up to paying to him when it is required. The third pillar is a pure technology pillar. And what it does is to ensure that the information that we hold, namely bank accounts and their ownership, cannot be compromised, cannot be manipulated, and there will be no unauthorized access to it. I won't go into too much details, but what we have done is to develop an innovative, unique infrastructure that allows us to combine the forces of multiple independent, different organizations that together are safeguarding the information without ever being aware of it. We call it cooperative cybersecurity, or CCS. The fourth and the last pillar is professional services. As you know, technology on its own is not very useful if you don't know how to use it. And here again, we are utilizing the synergy between KPMG and nsKnox and the deep knowledge and know-how of KPMG in business processes. So whenever we onboard a new customer, we first sit with him and analyze his existing processes, his payment processes, his vendors onboarding processes, and we identify any existing vulnerabilities, if there are such, and we also identify opportunities to enhance the efficiency of the process. And then we integrate our solution within his existing processes and remove any vulnerabilities and enhance the efficiency. So if I'm going to take a step back and to analyze what we're doing, you will see that, and if I'll circle back to what Israel defined as the top strategies to prevent fraud, we can see that these four pillars together fulfill these topics. First, this is a technology-based solution. It provides automation, and by that reduces the chances of human error. Second, it is a holistic approach. It takes care both of the IT level problem and of the business processes. And it provides a solution end-to-end, starting from managing the supplier up to paying to the supplier. Also, this is an external solution, and we're basing all the information that we have not on the first party and not on the second party, but we take it from independent third parties that are trusted sources of data. And last, because the information is technology-based and it provides automation, not only that you will be able to introduce new controls into your system, but you also be able to automate part of the existing ones, and by that make the whole process efficient. And in the bottom line, we can see that nsKnox's technology with KPMG business knowledge and know-how creates an opportunity that to have synergy that creates a lot of value to our customers. With that, I'm going to return the webinar to our moderator, Eric, so you will be able to ask questions.
Thank you so much, Alan and Israel, for this very informative presentation. We would like to open the discussion now for your questions. If you don't mind, please use the Q&A tab on your screen to post your questions. First of all, we have a couple of questions that were already submitted. Namely, the first question is, and this is actually, I think, for Alan, do you cover the validation of international bank accounts or just USA accounts?
Thank you,
Alan?
for this. Yes, can you hear me?
Yes, sure.
Okay, thank you for the question, Eric. And the answer is yes. We cover both international and domestic accounts. Of course, it doesn't mean that we have all the information from the first places in our database. As you know, there are millions of suppliers across the world. But the way that we answer this challenge is that either we have the information, and if we don't have, we have a process that we are able to gather this information very quickly when it is required. So if one of our customers is asking about a supplier and about a bank account that is not present right now, very quickly, we can add it to our databases and provide the answer.
Beautiful. Thank you, Alan. The second question that's already been submitted is, what about compliance? And I would like to direct this question to both of you, Israel and Ilan. Israel, why don't you start?
Yeah. So thinking of the customer side of the compliance problem here, of course. We touched on this briefly when Alan described the professional services angle, but at a very high level, a project would start with analyzing an implementation project. I mean, would start by analyzing the current state of the customer, the existing processes, systems involved, teams involved, etc., and then work to design a new and improved solution that does multiple things. One, it leverages the capabilities of the solution, all those additional controls that Ellen walked us through. Number two, it removes friction and complexity whenever possible. And thirdly, we make sure, and this is where I'm connecting to the question, we make sure that the new design, that improved process is not just fully compliant with common regulations, in fact, it helps customers more easily achieve SOX controls requirements, fraud control requirements, etc., so that rather than making those separate expensive initiatives, they actually get compliance and additional controls as part of the implementation process.
Beautiful. Thank you. Alan, you have a response?
Yes, I don't have much to add to Israel's response. I would say that first, nsKnox as a company is SOC 2 compliant, and also the product itself is GDPR friendly. So both these aspects are covered.
Perfect. Now we have a question that was submitted online, where the persons committing the fraud in the first three examples that were given caught, and if so, what resources were utilized to catch them? Either of you, Ilan or Israel?
I can take those. In those particular three cases, in two out of the three, the answer was yes. In one of them, remember, this was a bad insider, and he was caught. So, you know, that didn't require any sophisticated internet tracking to find him. And in the third case that we helped investigate through, cyber technologies and cooperating with the law enforcement agencies, the actual fraudster behind it was tracked. However, I wouldn't overly celebrate this. In many cases, the supplier is not caught, either because they are...
You mean the fraudster, Israel?
Sorry. Yeah, the fraudster, my bad. The fraudster is not caught, either because he's just sending the social engineered email from the outside or using hacking tools to hack into the supplier network and send the email from there. And unfortunately, I think it goes back to the comment on men versus technology. There are plenty of tools today for fraudsters to cover their digital traces, connecting to companies through layers and layers of proxies and essentially computers that hide their true presence and identity. So in reality, statistically, I think in most cases, the fraudsters are not caught.
Perfect. Can either of you, as a follow-up question that I'd like to raise, what percentage of the money that's being frauded from companies, estimated, of course, is actually recaptured?
Well, I can take this. Maybe I will say one word about the previous question. Even if the fraudster were caught, still the money is gone. So I'm not sure that this is always the only thing that we should consider. And as for the money which is being returned, then it really depends. Sometimes it is part of the money, sometimes it's not at all. And the reason for that is that most of the time, the insurance doesn't cover social engineering. It does cover the hacking into systems, but if there is a human factor around it, then the insurance doesn't cover it.
Yeah, and Eric, I would like to add to that, again, just reflecting without, of course, referring to any name, reflecting on some investigations that KPMG has been involved with or cases that customers actually shared with us. To be honest, if the fraudsters are doing their job well and flawlessly and not making mistakes, pretty much your only chance of getting the money back is if the transferring money or the receiving or the transferring bank or the receiving back spotted something. They may or may not have some anomaly-based rule to try and catch this, but again, smart fraudsters actually piggyback existing mule accounts to transfer the money around, so it will not look like an anomaly. We've seen fraudsters that were smart but not overly accurate and made a tiny mistake in the company name, and there was a mismatch that saved the paying company on the last moment. But again, in cases that we analyzed where fraudsters were professionals and did not make mistakes, there is very little chance for anyone to try and save the money and recapture it once the instruction was submitted to the bank or the clearinghouse, which is why a lot of the emphasis of our discussion today is what the paying companies could do from their accounts payable side.
Perfect. Thank you both. We're still open for more questions. If anybody would like to post a question on the Q&A tab, please. We'll give it a few more minutes, and if there are no more questions, that means we've done our job correctly, gentlemen. Any more questions? Well, I guess we will wrap it up for today. Thank you so much, Ilan and Israel. And thank you, everybody, for joining us today. And for now, have a great weekend, and we'll talk soon. Thank you.